Good evening to all the participants. The subject for today is the accounting and revenue recognition in real estate, and we will be looking at both the IGAAP, which is the the Indian standards, and the Ind AS, which is the equivalent to IFRS standards, which have been adopted by India. So these are, and also some of the practical examples and the practical things which are being followed by various listed companies across India. We have done some analysis of that, and that will also be presented, and some typical issues which are generally faced during the accounting and revenue recognition in such cases. So when you look at the real estate sector, it has a lot of facets to it. It has the construction work on the plots of land. The real estate developer does do that work. So either it could be residential, commercial, various types of developments which keep on happening. One peculiar feature about real estate is that it is an imperishable asset. Land, especially if you look at cities like Mumbai, the cost generally goes up, and there is a scarcity of that asset, and hence that becomes very, very important. And that is how the business models of some of the real estate companies does get developed around this fact, that whether what is the land bank which is available with these entities, that plays a very, very crucial role in terms of how the future of these entities is there, or what would be the future projects or the revenues or the financial stability of some of these companies. A lot of FDI did come in real estate sector, uh, and hence there is a lot of interest. A lot of companies which are today in private space want to become public. The number of listed real estate players have also increased significantly, and with that, the interest around accounting, obviously from a tax point of view, the accounting is very, very important, because the tax generally follows what is done in the books of accounts as an accounting method. And real estate being very, very complex in terms of the projects which are for multiple years, uh, there are a lot of accounting questions and challenges which we'll try to address in the next subsequent slides. As I said earlier, various type of developments happen, but from a real estate developer point of view, we will focus on residential, commercial, plotted developments. We will also look at sale of joint development rights or accounting as per the JDA agreements. We will look at it from both landowner as well as the developer perspective. We will try to look at SRA projects, what type of complications do come around in SRA projects also. When you look at residential, it could be a greenfield project, it could be society redevelopment, it could be a SRA project. Similarly for commercial sector as well. Within commercial, there could be two legs. Either it could be a lease model or it could be a sale model. And depending on lease model and sale model, the accounting treatment does undergo a change, because in case it is a lease model, then it becomes like a fixed asset or an investment property, and hence that accounting becomes slightly different. And if it is a sale model, then it is like an inventory or a work in progress. And hence the clarity, especially in case of a commercial project, whether it is a lease or not for a sale model, that becomes very important, because subsequently transferring from work in progress to finished goods would have some tax implications as well, and hence it is important to have clarity on some of these matter at the start of the projects. Plotted development is another area where people or the real estate developer buy a large plot of land, then they do the infrastructure, and the land is broken up into smaller plots, which are then sold to the investors or the buyers. And the buyers either construct their own villas, bungalows, or warehouses, or some of the, or so a lot of these things, or subsequently it is either done by the builder himself. And depending on the nature of contracts, how you account for the revenue, how you treat these contracts could undergo a lot of complications and a lot of to and fro. As I said earlier, we will look at revenue recognition under IGAAP, under Ind AS. We will look at various accounting policies of real estate companies, and this will give you an idea in terms of what are the ground level practices which are actually being followed. There are certain issues as regards capitalization of interest cost, which we will definitely try to look at. operating cycle in a real estate entity is very, very important, because if you all would be aware that in a balance sheet we disclose everything between a current and non-current, and the current and non-current classification of the assets and liabilities would depend on the operating cycle of a real estate project. And hence this is a very, very important subject which needs to be understood right at the start of the project, because you need to get the accounting right up front, and subsequently making those changes would not be possible. And we will go forward, when we go forward we will see how it is relevant to understand the operating cycle, because it has a lot of implications from a banking and a finance point of view also. So let us start from the basics in case so revenue recognition. And one of the questions which is always asked that what is the accounting standard which is applicable for revenue recognition in case of a real estate developer? And generally the answer is that people say AS7. AS7 is not the right answer, because AS7 is applicable only to construction contractors. And when I am developing, or when a real estate developer is developing a project, he is developing for himself and not for others. And hence it is not a construction contract. He does not become a construction contractor, and it is more of a development which is done and sold by the same person. And hence it is AS9 which is the right accounting standard which is applicable. AS9 is more of a principle based accounting standard, and it does not go into an industry nuances and all those things. And hence ICAI did come out with a guidance note on accounting for real estate transactions. Initially, there was one old guidance note which was replaced by this guidance note, and that guidance note provides a detailed guidance in terms of how should the revenue recognition happen in case of a real estate project. It has uh, broken up into multiple situations and provides a detailed guidance. And this has been the base on which the accounting happened under the IGAAP scenario, when the companies, especially the listed ones or the companies to whom Ind AS is applicable, 115 is the accounting standard in Ind AS, which guides the revenue recognition principles, and it covers all type of revenue recognitions. And that is the now the composite guide for revenue recognition. And we will go to that and how things change when you go from IGAAP to Ind AS. One of the most important thing that we need to understand is what is a project, what is a real estate project, for what we are doing this accounting. Uh, because project is uh, the definition of the project becomes very important, because unless you know what is the project, you don't know what are the costs which needs to be allocated to a project, what should be the budget of that project, what would be the percentage of completion of that project. And project, it may sound simple, but imagine a situation where the builder has 100 acre of land and he is developing things in various phases. Now, whether each phase is a project, whether each building can be a project, each tower is a project, those are questions based on facts of each cases we need to examine and we need to answer. Because if a single tower is a project, then the revenue recognition and the POCM would happen for each tower separately, and not for multiple other things which are there. And the cost which are incurred for the tower, not for the tower, and for the other parts of the land may have to be deferred separately, or they have to be inventorized separately. And hence this becomes very important to understand. A lot of times practically we have seen that the costs are incurred, work is started, but what is the project definition is not understood, and then subsequently the reallocation of cost and other aspects have to be done. And this creates a lot of confusions and errors which keep on happening while doing the accounting. uh, how do you define a project? Some of the criteria which you need to consider is whether the project is self-sufficient, whether the common amenities, entry, exits, whether they are same, whether it can be self-sufficient. So if the common amenities are there, whether it is shared by three towers, whether it is independent, separate swimming pool, separate gym, current in the current scenario, whether these are separate, these are different, uh, whether they are independently sellable or whether they are dependent on one another. All those things have to be considered before you define a project. And based on the definition of the project, you allocate the cost, because the costs which are directly for that tower you identify for that tower, and costs which are common maybe you'll have to allocate, or you have to have a proper accounting mechanism. Generally, steel, cement, and some of those items, they are procured in large quantities, and work may be done at various points, various different towers or different phases of the project. And hence, accounting and allocating those costs correctly becomes very, very important. There is one message that echo audio adjustment required. Is it okay now, or there is some problem in the voice? Thank you. So this is the relevance of the project, and hence we need to understand and decide what is the right project. And based on that, the trial balance needs to be structured. Your cost centers needs to be structured in that manner so that the right cost gets captured. These are again the basic principles of revenue recognition which we have learned from AS9. This is nothing new, but something which we can just revise before we go into slightly more complex things. The seller has transferred to the buyer all significant risk and reward of ownership and retains no effective control. Seller has effectively handed over possession. No uncertainty exists regarding the amount of consideration that will be derived from the sales. It is not unreasonable to expect ultimate collection of revenue from the buyers. These are some of the conditions which are there. These are very, very normal as a part of AS9. But in a real estate, this becomes slightly complex because a builder has launched a project and you book a flat in that project. Now, that flat may take 2, 3, 4 years to get constructed. And over the period of 4 years, how should be the revenue accounting done? Because upfront, answer is definitely no. Obviously, there is a question between percentage completion method versus completed contract method, which keeps on coming. And we will dwell into that answer as we go into some of the subsequent slides. But that is the challenge which is happening here. At what point of time the risk and rewards gets transferred? Is it on registration of the flat? Is it on possession? Is it brick by brick? As the work gets done, does it get transferred? Whether the buyer has a right to sell the flat in between, whether he can sell, whether he can't sell, uh, and all those factors. What happens during cancellation? Is there a unilateral right to cancel? There are some of the factors which you keep on reading the agreements, understanding those agreements, and decide how do you do the accounting for the revenue. So as I was speaking in the previous slide, percentage of completion method and project completion method, these are the two recognized methods. And these are borrowed from AS7, which is construction contract. AS9 also for services has some of the references to these two methods. When you go to the guidance note, what guidance note specifically says is that whenever the real estate transaction has features which are similar to a construction contract, which means it is spread over multiple years. There is an element of design, there is an element of construction, it's a mixed work. Uh, and in those situations, the work the is akin to a construction contract. It is similar to a construction contract, and hence in those situations you have to do, not you can do, percentage completion method. And generally, when you look at most of the real estate sale residential type of projects, or those real estate projects where commercial buildings are for sale, in those cases generally you will find that percentage completion method is the more appropriate method for revenue recognition accounting as per the guidance note, and this is a common practice. This is the definition of percentage completion, which is obviously well understood that you do as per stage of completion of the project. The complications arise in determining what is the stage of completion of the project. When should I do? When should I not do? Whether project is completed, whether 5% of the work is done or 20% of the work is done. And there a lot of challenges and subjectivity does come into the picture. And hence knowledge about the understanding of this industry becomes very, very important when you try to get into this aspect. These are some of the features of percentage completion method. Obviously, from the tax point of view or from an investor point of view, or sometimes if it is a listed company, there is a consistency in revenue recognition. By as you do the construction work, you recognize certain percent of the revenue. So obviously in every year there is a revenue which is getting declared, and a lot of times that is a preferred method, because there is a revenue which keeps on getting declared, or which you can keep on generating. From a tax point of view also, the amount gets spread over a period of time rather than at the end of the project. However, uh, some of the real estate builders would obviously want to do completed contract, because at the tax payment does happen at the end of the project when you do a completed contract method. And hence there is always a debate which keeps on coming, whether can I do completed contract method or not. So as I was mentioning in the previous slide, the percentage completion method should be applied when the economic substance is similar to construction contracts. And some of the indicators which are given, and I did speak about it earlier, that the projects is beyond 12 months. Individual units of the project are contracted to be delivered to different buyers, and these are interdependent or interrelated activities. Most features are there. So there is land development, structural design, architectural design, construction, everything is there. Construction and development activities form a significant portion of the project activity. These are some of the indicators, and these are usually there in most of the real estate projects. And hence, following percentage completion method is generally the more correct method as per the guidance note which is applied. In very rarely or very few situations, you would find completed contracts being used. These are the conditions for application of completed percentage completion method. And one of the thing is that the project revenues should be estimated reliably, because we should know what are the project's revenue, overall estimated revenue from the project, and hence all your approvals, all the designs and everything should be available, should be there on record, and otherwise you cannot really estimate the project revenues. It should be probable that the economic benefits associated with the project will flow to the entity. Project cost to complete the project and the stage of project completion at the reporting date can be reliably measured. So what is the stage of completion and what are the project costs incurred? You should be in a position to reliably measure those. Project costs attributable to the project can be clearly identified, measured, so that actual project cost incurred can be compared with the prior estimates. In this type of a real estate project, there are estimates which are required to be made, because there is a project budget which is there at the start of the project, and based on the project budget you start spending the money, and once the money is spent, you compare what is spent versus what was budgeted, and hence both these figures are required, and they need to be compared, and there should be a proper measurement of all these figures. Once you know the basic conditions for application of percentage completion, there are four critical criteria which are defined in the guidance note. One is all critical approvals are obtained, and this is very fundamental. All your approvals, including the CC, your RERA registration, any if there is environmental approvals which are required, or any other local body approvals which are required, they need to be obtained prior to you starting any revenue recognition, because obviously there were cases where people would have seen that revenue has been recognized, but really there is hardly any work which has happened, because either there is some approval which is a problem. uh, Another very important condition, which is there is reasonable level of development is achieved. And the guidance note provides a bright line test of 25%, and such 25% should exclude land cost. You can include the borrowing cost, but land cost should be excluded. And this is very relevant in situations like Bombay, where land cost could be a very significant portion of the project. And hence, by only buying land, I could achieve 30-35% of the project cost and start recognizing revenue when I have not actually started any construction work. This was something which the regulators wanted to avoid. That especially if you are in a listed company scenario, or from an investor point of view, you have purchased land, you have started the booking, and you have started doing the revenue recognition, which will not be very fair, because there is no groundwork which has actually happened. uh, 25% of project revenues to be secured by agreements. This is another condition to make the start of revenue recognition even more stringent, that you have to sell 25% of the project with agree when there should be proper agreements in place. And out of that, at least 10% money should have come. These are the four very, very critical conditions which are there. And unless those conditions are fulfilled, you cannot start recognizing revenue. So this is very, very important. Even the tax authorities are accepting this method of revenue recognition because they are, if they are part of the audited accounts, they are getting accepted. And hence, all the four conditions have to be very stringently checked before you start recognizing revenue. The important thing is that once you have achieved this threshold of 25%, then the revenue recognition happens at the total cost level. So there are two thresholds which are there. One is for the 25% trigger event for revenue recognition, and the second is for actually recognizing revenue. We will understand this further by two examples which are given in the subsequent slides. Uh, but it is this four criteria for anybody who is doing real estate accounting, or anybody who wants to understand real estate accounting, is very, very important. And these are something which is very, very fundamental. And you will see that when we go to Ind AS, though this bright line test is not mentioned, but still some of these factors are relevant even in those standards also. In addition to the cost method for determining the work completed, because there could be an argument why only cost is the right parameter, because cost need not be in symmetry to the work done always, because it is possible that in the initial stages the cost is high and the later stages cost is low, or initially the cost will be lower and the tail end of the project has a larger cost, and hence cost need not always be even, and it may not always be the best measure of work done, because there could be a possibility that architect certificate may be a better measure of work done. And hence this argument is always there, that why cost should be taken and why not a technical estimation, why not an architect estimation, why not a project engineer certificate. These arguments keep on happening. And hence what the guidance note says is that it does not prohibit other methods while cost is the preferred method, but in any situation, the computation of revenue with reference to other methods of determination of stage of completion should not exceed the revenue computed with reference to project cost incurred method. So, if you are using technical estimation, if you are using survey of work done or an architect certificate or something of that sort, the revenue recognition from that method cannot exceed what was permitted by the cost method. So now what we learned is that there are three or four methods by which you can estimate the cost of completion. Cost method is the preferred method, but there are still other methods which we need to be aware about, which we need to understand. But the recognition can be lower by other methods and cannot exceed the cost method. So this is something which we should understand very clearly, because it can be important when you are advising somebody, when you are doing the accounting of some of these projects, to have this background very, very clearly known. So this is the example which is there in terms of the one of the project. We will look at the trigger event calculation. Sale area is 20,000 square feet. Total area sold till date is 5,000 square feet. Total revenue receivable is 200 lakhs. Amount realized is 50 lakhs. The estimated cost is 300 lakhs and 300 lakhs for land and construction. Cost incurred is, the land cost is fully incurred because land is bought. Construction is only 60 lakhs. So when you look at the numbers, we realize that the construction and development cost is 60 out of 300, which is 20%. It does not meet the trigger of 25%, though the other criteria meet. But since the construction does not come to 25%, there cannot be any revenue recognition, and whatever cost is incurred would be carried forward as work in progress. This is the situation 2, where the other facts are similar. The construction cost is 90 as compared to 60, which was there in the earlier slide. And basis that it is 30%. So here we know that the threshold is 30%, And now when we go to the revenue recognition, revenue is recognized at 65% because 300 lakhs of land was already purchased and that cost has already been incurred. So when you do the revenue recognition, it is the total cost of the project divided by the proportionate cost which is incurred. When you look at the total cost of the project, obviously it does not include marketing, it does not include brokerage, it does not include administrative cost. It includes only the cost which are directly or indirectly attributable to the project. So salaries which are related to the project engineer salary, site engineer salary, the site related cost, site related cost, those can be considered, but brokerage cannot be considered, your marketing cannot be considered, launch expenses cannot be considered. One of the questions which always comes about is the launch expenses, because there are a lot of expenses in advertisement and marketing which happens at the date of the launch, and there are arguments or there are questions why it cannot be part of the project cost and why it can't be deferred, because the benefit of the launch may happen over a certain period of time. But the accounting standards are very, very clear that if it is a marketing cost, it has to be debited to profit and loss straight away. And hence, in a real estate company, you may come about in a situation where in year one, there is no profit, there is no revenue which can be recognized, but there are large marketing expenses which are debited to P&L account, and hence there are losses in the initial period. And because of that losses, obviously there could be impact on the capital structure, the net worth and other factors, and this needs to be understood prior to uh, the project launch, because your capital structuring and how you want to structure the entity, how you want the future things to happen are very, very important, because a negative net worth may not be looked at very, very kindly by the bankers or investors when you are doing a fundraise. And hence it becomes important to understand these things in advance, that these are going to be the implications in accounting, and hence we need to take some safeguards, or the planning or the structuring needs to be appropriately done. When you look at sale of land or plots, and I talked about plotted developments, if it is a simple sale of land, you do the revenue recognition when the sale agreement happens, when the possession is given. If it is a plotted development, you look at the work which is required to be done, whether the infra or the other activities which are required to be done, what is the cost of other services which are required to be done, and based on that, percentage completion method may be more appropriate in such cases, because there are a lot of other obligations of the real estate developer which they have to do. For example, it could be a case where the roads could be the real estate developer, it could be common amenities, it could be electricity connections, it could be water connection, it could be fire related safety, it could be compound walls. There are a lot of such obligations in a large plotted development which are there. Another typical example which does come out in a real estate is, there are cases where the real estate builder sells a plot of land and then you enter into a separate construction contract with the same entity, and the construction work is given to the same entity. Now the question does arise whether the sale of land and construction contract are separate contracts, are simple contracts, though from a legal angle you may have to evaluate, but if they are interconnected and there would be a strong argument that you may have to consider them as a single contract for a purpose of accounting and not as a separate contract. But the final reading of those agreements are important before you finally conclude on the better method of accounting and revenue recognition. But these are typical questions or typical issues which does arise when you look at some of the type of projects. When there are tenancy development rights, if they are acquired by giving up rights over existing structure, then it is like a barter transaction and it should be recorded as per fair market value or the net book value of the portion of the asset given up, whichever is less. Uh, and if it is done as a TDRs are acquired by a direct purchase or development or a construction, then the cost would be part of the project cost. Another typical feature which does happen with a lot of real estate entities today is joint development agreements. There are entities who are land owning entities or people who have more skills in acquiring land, or they have a lot of land which they have acquired, and they get into a joint venture or a joint development agreement with a real estate developer, and it uh, it is a method of transaction where the purchase of land from a real estate developer point of view does not have to pay upfront, because either he is paying by way of an area share or by is paying by way of a revenue share. And hence it has become a very convenient mode of real estate transaction during the recent past few years. Initially there were certain benefits from a stamp duty point of view. To my best of my knowledge, now they have gone away to certain large extent, and there may be certain other issues which may be happening there. But JDA is a lot of preferred method today, because instead of paying upfront for the land cost, uh, there is a benefit from a real estate developer point of view that he will pay out of the revenue proceeds, or he may give a free of cost area. Hence, the entire payment could get deferred and it gets linked to the work getting done and the construction happening. And from a landowner point of view, it is beneficial from his perspective, because he may get a larger pie when the area is developed and where the real project gets developed, because the benefit out of a completed development may be significantly greater than what is there on a bare shell land. Uh, and we have seen that happening in Mumbai at various places where the total development, once the area is completely developed, the land prices really go north, or the building prices really go north once the substantial work is done, or substantial areas get start to develop, because then the entire ecosystem gets developed around that area. And hence the landowner may also feel that if the area once it is developed, I may get a larger share in future, and hence those becomes a win-win arrangement for both the parties. And hence this type of arrangements happen. But these type of arrangements do pose significant accounting questions, because uh, the once you do the accounting, your tax also follows. For example, in a JDA, landowner A can get into an agreement with real estate developer B, and he said that you can use my land, construct your project. In consideration, you can give me certain percentage of area free of cost, which I will then sell in the market, or you give me a revenue share. You sell the entire project. Out of the total revenue which you are earning, 20 to 30%, depending on the negotiation, is shared with the landowner. So these are the type of uh, agreements which are quite common in the real estate sector. And when we look at the accounting, if I am a real estate developer, I have committed to the landowner that I will give a certain area free of cost to him. That obligation to give such an area free of cost is a liability which needs to be brought in the books, and hence that liability needs to be provided upfront based on the value of the area which is to be given, and that may have to be reviewed on a periodic basis, because under accounting standard 29, you may have to make a provision for all such obligations. So that in that way, that is like a land cost in a way, and that liability needs to be fully provided for. Typically, in case it is a revenue share, because there are no direct direct area which has to be given, the total saleable area is reduced by that extent. And when you do your profitability computation, and it does take care from that part of it, so that you do not take it as a part of your own revenue at all, and it's a revenue which is you are doing free of cost liability. And hence that accounting takes care from that point of view. And there could be either fixed and a variable also, in that further variations do happen, and accordingly the treatment will be done in the books of accounts. From a landowner perspective, if it is a revenue share, at what point of time accounting should be done? Or even if it is an area share, at what point of time? Because I have transferred my rights over land to the builder. Now, whether I should account it upfront, whether I should account it on a percentage completion basis, if there are obligations which the landowner has, because there could be some obligation on the landowner also, whether he should account it based on those obligations, or whether he should account it as per the percentage completion of the developer based on the project, how the work progresses. Or the fourth option is on a once he receives that area. So there are multiple options which are available depending on the nature of the agreement. You would have to determine at what point of time the risk and reward is transferred, and at that point of time, appropriate revenue recognition accounting will have to be done. But this is a very critical and a crucial decision which needs to be taken, because a lot of other implications, including taxes, including the other, from an investor point of view, from a stock market point of view, in case it is a listed company, results point of view, are part of that implications, and hence this needs to be studied properly. But in case it is an area share, it is not right that you say that whatever area share I receive upfront as a cash flow is my revenue. Cash flow need not exactly be equal to revenue, but it has to be done based on either my obligations, completion of my obligations, or the overall obligations, or the overall transfer of risk and rewards. So it is not necessary that if I received some cash, it is revenue. This is a common mistake which happens, that when in case of an area share, that revenue is shared and it is immediately accounted as revenue. It need not be correct, and how you amortize that over the overall period. In Mumbai, especially, you have something which is called as a Slum Rehabilitation Authority, and there are a lot of SRA projects which are going on all around Mumbai. And typical features of SRA is that there is no land which is there with the real estate developer. What he does is that he vacates the slum developers, he creates a rehab building for them, and based on the rehab building, he gets a certain free sale area. And that free sale area and the FSI, based on that, the sale building is constructed and which is there for his own sale. This is a very typical arrangement which happens only typically in Mumbai, especially. And we need to understand some of the nuances, because from it is slightly different from a normal real estate project, though fundamentally same, but there are certain complications which do arise. For example, a lot of cost which are incurred in a rehabilitation project, or the relocation of these slum developers, those all are similar to land cost. Uh, for example, hardship compensation. Now, how do you account for that hardship compensation which is paid? Is it based on payment? Is it based on obligation? Because this is like an alternate accommodation or an alternate rent which is paid. So you do not do a cash-based accounting. You do based on what are your obligations. So if you have paid 3 years rent together, ideally you should do a prepaid accounting. Or if there is a payment which is not done, ideally a provision should be made. There is a cost for accounting slum dwellers, vacating slum dwellers. There, and in a typical slum, some of them may be registered, or some of them may be approved by SRA, and some of them may not be approved by SRA. But there is a cost which is there to vacate those slum dwellers also, and hence, what are the nature of supportings which are available? What are the payments and the nature of payments? How it has been accounted for? What are the supportings? Who are the recipients? Whether the KYC of the recipients is done, not done? These are all some of the typical things which you need to understand while accounting for this cost, or while doing a proper record keeping, from an if you are from an industry point of view, and if you are from an audit point of view, how do you validate these are the payments which have gone to these people only? Then there is a construction of rehab building. Within the construction of rehab building, it's like a normal building, and once the rehab building gets constructed, you get your LOI. Though LOI application happens in advance, and it is said that the FSI which is generated is brick by brick basis. So as you complete the rehab building, you generate the FSI. There are a lot of licensing related expenses, and a lot of expenses relating to alternate accommodation, which we spoke about earlier. One of the critical feature of the SRA project is that you have various number of slum dwellers which are there, and out of that, the approvals may come for a few, and then you have a FSI at one stage of certain number. Slowly and steadily, the FSI or the sellable area increases. Now, because of the LOI revisions, the cost then starts get spreading over multiple number of FSIs. It is possible that today, when you started an SRA project, you have an SI, you have an approval only for 2 towers, and by the time you constructed the second tower, there is an approval which is available for the third tower as well. And hence, it is very important to keep a close tab on what are the estimates for the area which is used by the company while doing the revenue recognition accounting, whether there are any changes, how those changes are getting accounted and reflected in the books of accounts, in the audited accounts. That are also very, very important, because it significantly changes the entire dynamics, entire profitability of the project. The estimations of the project play a very important role in determining the project cost, the estimations of revenue, because without the budget, you cannot do a percentage completion. It's like a numerator and a denominator, and it is very important to have a right numerator and a right denominator. How the budget is being prepared by the management, what are the factors which are considered, what are the costs which are considered, what is the basis on which the cost is considered. There has to be a reasonable level of certainty about the cost which are considered, whether inflation is considered, not considered, because project is going to last for 4, 5, 6 years. It is not going to be completed within next 12 months. Is the time value of money factored? Those are the type of questions we need to ask, we need to understand while looking at the project budget. And while doing the project budget or while reviewing the project budget, we need to understand what is the project all about, what is going to be my deliverable. Have I committed to deliver swimming pool? Have I committed to deliver a tennis court? Is a clubhouse part of the project, not part of the project? What are the amenities which have committed to the customer? Is it Italian marble, it is, or is it a normal tiles? Is that what are the design specifications? Some level of understanding is required, because without that you cannot have an estimate of the project budget. And those budgets gets revised very frequently, because the design of the real estate project does evolve, and there are multiple design changes which happens in the journey of a large real estate project. And as and when the design changes, the cost does have a change, and based on that, your revenue recognition, the project budget, the foreseeable loss calculation, the NRV calculation, the inventory calculation, everything does change. In case there are changes in the project estimation, they are accounted in the year in which the estimates are changed. There is a disclosure which is required under the accounting standard for changes in estimates, and those have to be made. This is generally missed out because it's so frequent and so many changes, and it's little complex in the real estate industry. However, strictly speaking, a disclosure is required. Another concept which needs to be kept in mind is the project cost. If it is lower, if it exceeds the estimated revenue, then the loss has to be accounted immediately. This is a fundamental accounting concept. Now, when we go to the Ind AS portion, uh, and when the Ind AS 115 was introduced, everybody said that the real estate build cannot do percentage completion method at all. It has to completely go to completed contract method, and that was a constant rumor, constant view at that point of time. Some of the real estate builders also, and in fact most of them also, went into completed contract method. Institute of Chartered Accountants came out with a clarification saying that it is not that 115 prohibits percentage completion method. However, it depends on the terms of the contract, and basis which a informed decision needs to be taken. Uh, Under 115, you can do complete percentage of completion if any one of the following three conditions are fulfilled. A customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity performs the obligation. The entity's performance creates and enhances an asset that the customer controls as the asset is created and enhanced. So the asset is under the control of the customer. The third condition is entity's performance does not create an asset with an alternative use to the entity. So entity cannot have an alternative use, and entity has an enforceable right to payment for performance completed to date. So in case any of these three conditions are fulfilled by the contract, then you can do percentage of completion method accounting even under Ind AS 115. So this was a myth, or this was one big argument which was happening, that it is not possible. So it is not that it is not possible. It would depend on the contract. There are examples which have been given in the education material for Ind AS 119, and it has explained very clearly in which of the situation the percentage of completion is possible and where it is not possible. So in this example, it says that P Limited, which is the party developing the real estate multi-unit residential complex, retains the legal title to the real estate unit. Customer can resell, pledge. P Limited cannot direct the unit to the another customer as per the contract. In addition, customer does not have the right to terminate the contract unless P Limited fails to perform as promised. These are the conditions. Additionally, in this scenario, consider this one more condition, which says that if the customer defaults on its obligations by failing to make the payment, which are due, entity would have a right to recall all of the consideration promised in the contract, and if it completes the contract. So you have right to the work which has been completed. You have full right to the payment of the work which has been completed. In such a situation, you can do percentage of completion method. However, if that condition is different and you are not having a right to recover the full payment of the work done till the date of cancellation, and you have only right to retain certain deposit, then you cannot do percentage of completion method and you have to do completed contract method only. So these are the important guidelines and the important conditions on the revenue recognition as per Ind AS 115. There are certain other examples in case of determination of transaction price, because there is a financing element in case of schemes like 80/20, which are very, very common. The financing element has to be brought about separately, which is the fundamental principle of Ind AS, that you do a fair value of the consideration. And if there is an interest element, you bring out that separately. So this is the example there. And this is also one of the differences between the IGAAP accounting and the Ind AS accounting. Now, what I have tried to do is summarize the accounting policies of around 17 companies which we did, which we analyzed. And what we saw is that around 13 out of 17 followed completed contract method. So it's a eye-opening scenario. Around 4 companies, and out of that, only one which has very recently started, which has changed the method, has done POCM. So that is the current market practice which is happening, where with PCM versus POCM. And there is one more reason behind this, which will come in the subsequent slide, why a lot of companies do follow completed contract also. One is definitely their contracts may have terms which could be not be which based on which the percentage completion may not be permitted. But there are one or two other reasons also from a practical point of view. Uh, this is one slide where we have tried to compare what is different. If you ask me, in spirit, there is very, very little which is different. Yes, the guidance note provided the threshold limits. Ind AS 115 does not provide any threshold limit, but it gives a rule. It gives a fundamental rule where it says that if entity is unable to reasonably estimate the progress, especially in early stages, entity should recognize revenue up to cost. So it says you don't book profit. And in a way, it says that if it's a very early stage contract, you do not book profit. So it is in a way fundamentally very similar uh, when you follow percentage completion. It talks about input method and output method. So both the methods are permitted. Generally, the industry practice is to follow the input method. The cost method is used generally, but other methods are also not prohibited, which should be kept in mind. Another typical feature of real estate accounting is to understand the operating cycle. I started with that, and I will touch upon very briefly on that point. Is that the operating cycle, for example, in a real estate company or a real estate project, would be 5 years, and in a real estate company, there would be multiple projects. So it is quite possible that the operating cycle would be different for different projects also, and hence the current and non-current classification has to be done very, very carefully. For example, if I have taken a 5-year loan and the project operating cycle is also 5 years, the entire 5-year loan will be a current liability and it will not be a non-current liability part of it. And hence, that is very, very important, because the current ratio between current and non-current significantly changes once you apply the operating cycle rule correctly. And from a banking and a financing point of view, the ratios are very, very important. The debt equity ratio, the current asset, current liability ratio, these are fundamentally very, very important. And these type of things does impact the ratios. And hence we need to be very clear, either if from an industry point of view, also from an accounting point of view also. These are the factors which need to be clearly understood, examined, and decided at the start of the project. Borrowing cost capitalization is another area which is very, very important. Uh, So there are two types of borrowings. One is a general borrowing cost, and second is a specific borrowing cost. Specific borrowing costs are directly allocated to the project. If it is general, you do a weighted average borrowing cost. Very typical scenario under Ind AS is that borrowing costs are not allowed to be inventorized post launch of the project, where revenue is recognized on POCM basis. And I think this is very important, because if you are recognizing revenue on percentage completion basis, you are not allowed to add borrowing cost to the cost of the project. And hence, if you are heavily debt funded, it may have a significant impact on the way your accounting happens, where your profit and loss account gets structured. And the choice of accounting policy should be carefully made by understanding some of these aspects. Though we were only about revenue recognition, I thought fit to bring about the borrowing cost point also, because it has a in a way link to how you should do your revenue recognition accounting policy selection also, or how your agreements needs to be drafted, so that you are not unnecessarily burdened with the cost of cost of finance being debited, because most of the real estate projects have a heavy debt financing which is there. So this is the case study which is there. We have a little shortage of time, so I think we will not get into that at this point of time, but that will be part of the presentation which will be shared. So this is briefly which I've tried to cover the revenue recognition aspects. We can have a question answer and some interactive part for next, I think, I don't know, for next 10 or 15 minutes based on the organizers and the time availability. Yeah. So in case there are any questions, or in case there are any points, because it's a subject which are there are a lot of debate can happen in various matters. Yeah, there are some Q&As which are already there. Please throw some light on the effect of ICDS on accounting as well. Uh, if you ask me, there is no ICDS which is applicable to only real estate developers. The ICDS is revenue recognition only, which is there. So whatever accounting treatment is followed in the books, in my view, is acceptable to the tax authorities. Though I am not a tax expert, but in my view, there is no specific ICDS for real estate transactions, or for real estate builders. There is only one ICDS on revenue recognition. The next question is, while choosing percentage completion, do we decide as per the expenses incurred as per books or actual work done? Architect certificates sometimes show a difference. So as I said, if you are following IGAAP, then there is a possibility that you can do based on architect certificate, but the revenue cannot exceed the cost method. This is what I did cover earlier in the presentation. The guidance note specifically talks about this. In case percentage of completion, there is an approval cost. Normally, approval is received at the beginning and the approval costs are calculated. While developers delay this by taking deferment, whether full approval cost should be considered for percentage completion, or it should be basis the demand raised and the payment done for approval cost. With respect to approval cost, the entire estimated approval cost should be part of the project budget. Whatever approval cost is due, even if you have not paid, if it is due, it should be provided as a liability, and then it can be considered for POCM calculation. Whatever is due, so based on the approvals obtained or based on the work done. So if you have constructed up to fourth floor, and for the approvals up to fourth floor, require this cost to be incurred as an approval cost, that have to be duly provided in the books of accounts, and then it can be considered for the percentage completion method. In case of 25% of the project revenue to be secured, uh, the whether agreement registration is compulsory or allotment letter is also fine. In my view, the more correct practice would be the registration of the agreement, because even now under RERA, 10% is the threshold. By once the 10% of the money is received, it is mandatorily required to be registered, and hence not registering an agreement after 10% of the proceeds would be a RERA non-compliance also, and hence registration is more correct answer. Though I have seen some real estate companies where based on allotment letter also revenue is recognized and they have taken a legal position that the allotment letter is also having the same legal validity as an agreement. That may be more of a legal position which some people have taken. Is it transferable development right or tenancy development right? Both are there. This definition is interchangeably used. I agree with Mr. Naveen Kapoor when he's mentioning this. RERA Act of 2016 mandates that the promoter must refund the money received upon termination or cancel of the contract by the allottee. However, Ind AS requires that enforceable right to payment for work completed to be established in order to recognize percentage of completion. How can this issue be resolved in order to recognize revenue over time in accordance with Ind AS while adhering to RERA provisions? This may be very difficult to resolve, and hence we have seen most of the companies not recognizing revenue as per percentage completion of the method, because if you have to refund, then there is no enforceable right. However, if some legal opinion can be taken in terms of 115 versus the RERA Act, and the refund of money maybe only a very extreme cases, or a few cases, then there may be some possibility to look at it. To my understanding, most of the real estate companies who have followed percentage completion, they have taken some legal opinion or some legal advice based on their RERA agreements versus 115 to say that the enforceable right is there because the work is completed and they have some right, and the cancellation cannot happen only because the customer does not have a right to cancel unless there is a default on the side of the promoter. This is the position which people are taking currently. That if the builder is constructing as per his obligation, the customer does not have a right to cancel. And most of the allotment letters also do not permit the customers to sell or sell below a certain price, and a lot of conditions are put in the allotment letter. So the agreements and the allotment letters drafting has been taken care to meet this uh, condition. What is the method of accounting to be followed for construction cost on leased land? If the that will depend on how big the lease period is. If the lease is for what period and the eventual treatment of the asset. If the lease is for a very short period of time, then the answer could be very different. And if the lease is for a very long period of time, the answer would be very different. So we need more facts in this case to have more answer to it. The last point which they say the ICAI permitted that 35C where performance is permitted. However, most listed companies in construction are showing completed contract method. So I did answer that question earlier, and according to me, in my view, the interest cost which is not being permitted to be added to inventory is also one of the reason why most of the real estate companies do not want to follow percentage completion method. So that is one reason there. Second, obviously, is the taxation where the tax liability does get deferred to the completed part. So there are other advantages also of a completed contract method, and the issue of accounting estimates and the changes happening and going up and down also gets resolved. So there are also these are also some of the views which are taken by some of the listed companies to say that a percentage completion may not be more appropriate, and they are happy with completed contract method. For a real estate developer, what are the key metrics to track performance of the company, because revenue is not from a real estate point of view. I agree with Anubhav that the revenue is not a good metric. People look at the cash flows, people look at the inventory, the land bank, uh, and the advances which are getting collected, the bookings which are happening. These are some of the factors which people consider to track the real estate company. Cash flow, bookings, land bank, and the launches of the project and the work which is happening on the project. Those are the matrices which should be tracked, because the revenue is an eventual outcome. If the work gets done, the revenue will definitely get booked. The timely completion of the project is one of the most important metrics. For tax audit turnover purpose, though this is not the subject which is covered in this presentation, the gross receipts are considered. That is one conservative view, that you should consider the gross advances for the purpose of tax audit and not the POCM turnover. Though very aggressive view can be taken to say that POCM is my turnover, but the tax audit uses the word gross receipts, and hence the gross advances from the customers should be considered. I think this question I have answered. It's repeated. This revenue CLDs are not taken into consideration while recognizing revenue. This also I did answer that registration of the agreement is very important now, even considering the RERA requirement of 10%. How come Obero Realty Limited follow? Obero Realty, I also showed in my presentation, there are 4 or 5 entities, and they would have gone based on the fact that the customer cannot have a right to cancel only. And hence the question of refund does not arise, because the agreements would not permit them to cancel the contract unless there is a default by the real estate developer. Plus, they would have supported that with a legal opinion also, and hence on that basis they would have considered this POCM. The chat box also, there are some questions. Uh, First question is, can you change the method of accounting from changes of method of accounting from completion to PACM? One, that if it is an error, it would be more like an error, and hence it would be very difficult to change. Uh, Practically doing it may be very difficult. Is there a specific criteria for deciding PCM and POCM? I've already covered that in my slide. Guidance note gives very specific criterias. And in most of the real estate projects, which are for more than 12 months, the criteria for POCM will apply. Whether payment of DP to landowner is considered as cost. What is DP? I could not understand. So I am not sure what is DP. Very difficult to understand this. How to recognize revenue in the books of the developer? In case of, I have answered this question in one of my slide, how to recognize the revenue in case of a developer, in case of a joint developer. So if you are a developer, the revenue will be there. Yeah, uh, yeah. So in case of a developer, if you've taken the land from a landowner, then I have covered it in my slide that you will provide for the obligation of the landowner, and you will recognize the revenue as per the POCM or as per the guidelines, either if you are following Ind AS or if you are following IGAAP, depending on the revenue recognition guidelines. Uh, difference difference cost on account of allocation of flat against land sharing to the land. I think this question needs more elaboration, because difference paid is cash. This question needs more facts to understand. Uh, So I've tried to answer most of the questions where facts were clear. In one or two cases, the facts are not very clear, so it's difficult to answer that question. Maybe somebody can write that over an email, or separately we can discuss that question with more facts.